All right. Welcome, everybody, to our weekly Finance Friday Wealth Creation course. My name is Jerry Fetta, owner, founder, CEO of Wealth DynamX. And tonight we're talking about stocks, or as I lovingly call them, stonks. But I want to share with you why I call them that so that you don't think I'm just hating for no reason. Before we jump into this, I want to give you a little bit of background about myself. If you're a current client, you know me already. You've been watching these maybe even for the last 4 years as we've been doing them. If you're not yet a client, so I own a company called Wealth DynamX, and my mission and purpose in life, my company's purpose in life, is to help create financially educated and solvent families that are achieving greater financial freedom in their lives and sharing the truth about money with those around them. And so on these Friday courses, we handle one or two of those four things, right? So we help you become financially educated, learning the truth about money, right? So tonight we're going to learn the truth about stocks. We're going to learn the truth about other options for investing. And this is also an option and an ability for you to then share the truth about money with those around you, right? So if you're watching this, share the stream, get it out there. If you're on Facebook, if you're watching the replay, and you're on YouTube or whatever it might be, part of this is you sharing it, making sure that other people get the same information you get, because not everyone tunes in on a Friday night, right? So if you're watching this, make sure you do that. Now, a couple of things I like to go over every week. Number one is have a purpose in mind for being here, right? So why are you here? What made you tune in? And there's got to be some reason. Why are you trying to get this information? I put out promotions. My team said, hey, we're doing a course tonight. Maybe you're somebody's guest. Maybe you just wanted to learn about stocks. Maybe this is something that you didn't know really why you came, but you're here and you're trying to figure out what you're going to get from it. But try and have that in mind. Okay. The second thing is the idea that money is confusing is totally a myth. Okay. One of the number one barriers to learning about money, one of the number one barriers to learning about how to build wealth is thinking that it's too hard. Right? It's not too hard. It's something that anyone can learn. It's basic vocabulary and it's basic, addition, subtraction, multiplication, and division. And most of that we do on a calculator now, right? So if you can understand the numbers, you don't need to know the vocabulary. You can call it whatever you want to call it, right? You could literally make up your own vocabulary. All of it's made up in the first place. A bunch of fat cats on Wall Street said, let's give everything these fancy names so people are confused and they feel like they should pay us fees for our expertise, right? How about that for a trick? Let's make up words to confuse everyone and then charge everyone money to tell them what the words mean, right? That's literally what happens. So the idea and the topic of money can be understood, and it can be understood by anyone that knows basic math and how to use a dictionary, basic vocabulary, right? Now, the second thing is in order for me to learn about wealth, in order for me to learn about money, I have to remove what is called a fixed idea, right? The idea that I know it all. Right? That I have this piece of information that maybe I got from my mom or my dad or my financial advisor or my coworker at work, or maybe I just saw it enough times on the news or on social media. And so because of that, to me, that's the truth. And I'm never going to check to find out where it came from or if it actually works. Right? So much of life goes by where we don't ever inspect the information we have. How are we ever going to get ahead believing the same thing everyone else believes? Never wondering, like, where did they get it from? And where did the people that they got it from get it from? And does it actually work in real life? Right now, the good news, guys, is with finances, it's math. So we don't have to do very much to figure out if this works in real life. We just have to look at the calculator. We just have to look at the results. Right? And so if it doesn't work in real life, we're going to see that plain and clear as day. Okay. We're also going to see that with the people around us. So I'm going to talk about stocks tonight, which that's one of those areas. Maybe if you're not a client of mine, this might be an area. If you're a lot of my clients, they already know this and it might be some review, but if you're not a client, this might be an area where you're doing it because you're supposed to, and your financial advisor said to, and all your coworkers said to. And so you're putting a little bit of money in your retirement account every week, every month, right? And you're putting it in the stock market and you think you're going to retire on it and all this other stuff. Guys, look at the statistics. People aren't doing well financially. The average retirement balance is like 70 grand. Right? The average retiree will run out of money within 10 years of retirement. So when you look at the people around you and you're like, they're not doing so well. Let's relate this to fitness. Like let's say that the majority of the population told you that they had the secret to physical fitness and there was, this thing that you should do. But everyone that said to was out of shape. At some point, wouldn't you look at them and be like, hey, I love you, but maybe your plan doesn't work. Right? Why don't we do that with finances? The broke guy at work shouldn't be the person we listen to. right? Like if our parents aren't doing well financially, love them to death. That's not who I'm getting my retirement advice from. Okay. And here's the thing is the people that are winning, we've been taught to hate. The 1%. Oh, they're the devil. They took the money from everyone. Guys, like it's literally like maybe a few of them did, but it's impossible for all of them to have just stolen everyone's money away. Think about that. For me to even be a millionaire, it means that I had to sell $1,000 product 1,000 times, right? 1,000 times 1,000, right? So that means that I would have had to rip someone off 1,000 times in a row and nobody found out and nobody told anybody. That's just to be like earning $1 million. To be a top 1%er, I have to have a $10 million net worth minimum, which means I earned greater than that. I saved greater than that. And then I invested and built that up. It's like statistically impossible for us to look at those guys and say they're all unethical. All of them got there by thieving and stealing and ripping people off. Like that's a lot of transactions. Let's just do the math on this. If I had a $10 million net worth, guess I'll only use my calculator here. I'm going to show you how easy the math on this is. If I had a $10 million net worth, right? And let's say that it's just I saved it in cash and I'd been saving 40% of my income, right? So that means that I would have had to earn 25 million. Let's say that my tax rate on 25 million is 40%, right? So that means in order for me to actually like take home, right, $25 million so that I could, after taxes, save 40% of it, I would have earned about $42 million, right? That's like net profit before taxes. Let's say that my profit margin in my business is 40% as well. So for me to keep $12 million, I probably need to earn 70 million, right? So let's say that I sell $1,000 product. Let's just do the math here. That means that I had to rip off 70,000 people over and over and over. And nobody told anybody. Nobody said, hey, that guy ripped off 69,000 people. You shouldn't be the next one. Some like, you see what I mean? It's just ridiculous to think that the 1% are these evil people. Maybe a couple. Like I'll give you like Jeff Bezos, or not Jeff Bezos, freaking Bill Gates trying to block the sun. Like that's some weird guy, evil guy from the Simpsons stuff right there. But most of them aren't that way. And so we can't learn about something that we hate, that we're taught is bad, that we're taught is wrong, that we're taught is evil. We take it back and we apply that same concept to fitness. It would be the equivalent of saying all of the healthy people are evil because they somehow took all their calories that they consumed and they pushed it off on everyone else. And that's why they're fit. And there's just not enough muscle and fitness to go around. It doesn't make sense. That mindset doesn't equate. You see, so we have to get rid of the idea that we can't learn about money. We have to get rid of the idea that we know it all. And we also have to get rid of the idea that the people that have achieved that are evil and we shouldn't learn from them. Everything I know, I've learned from the top 1%. Right? I studied these guys, and I'll tell you what, like go read John Rockefeller's biography. That dude, for sure, I think he was an evil guy. Was he intelligent? Definitely. Right? So it doesn't mean that we can't learn from him. We don't have to go hang out and meet his family and be friends with them, but we can learn, okay, what did he do? Right? Objectively speaking, what did he do? I don't care what I think of him as a person. He did some math and that math worked, and it still works today, 3 or 4 generations down the road. Right? So I have to remove the emotional connection. This is something I'm going to give you as we start. Money is not emotional. Money is mathematical. You put a decimal sign there. You put digits in there. Or you put a dollar sign in the front. There's no hearts involved. There's no emojis involved. Right? So if you play a logical game based on emotions, it's very difficult to win that game because you're playing with the wrong rules. You're playing with the wrong basis. Right? So I wanted to open up with that. Okay. And then the other thing is, definitely ask questions, guys. This is not like high school where you have to raise your hand and you're going to get ridiculed because you asked a dumb question. I had a teacher that told me one of the greatest things that ever stuck with me is in 10th grade geometry. The guy said, hey, I would rather have you raise your hand and feel like an idiot for 10 seconds asking a dumb question than to actually be and remain an idiot for the rest of your life because you never asked. Okay, think about that. Okay, so don't feel like you're not, like, if you have a question, probably everyone does. Throw that in the comments. If you're on Zoom, we'll go live. We'll talk about them every 15, 10 minutes. So I like to stop and answer questions. If you're on Facebook, drop them in the chat. Speaking of Facebook, if you guys are on Facebook, definitely share this stream and get this out there. And I actually, because we are expanding and we have more staff, I had some time to actually put together a PowerPoint for you guys tonight, like we used to do back in the Anchorage days. So those of you that are OG Anchorage clients, We're back to the PowerPoints. Okay. So this is going to be stock versus private lending. Okay. Stocks versus private lending, right? Now, most people here are familiar with stocks. Okay. If you're a client of mine, you're probably also familiar with private lending. I wasn't familiar with private lending when I sold stocks. Okay. So I was a financial advisor from the age of 18 till about 22, 23 years old. I sold stocks. I sold mutual funds. I sold retirement planning, and I did not know what private lending was. Right? Look at that, the pen. That's awesome. So I didn't know what private lending was. And so this was something I had to learn. So let's go ahead and define these really quick. So stock is a certificate that says you have a partial ownership in a publicly traded company. Okay, that's what stock is. Okay. Private lending means that I had money and I literally loaned that to somebody and they purchased an asset, and I'm the mortgage. I'm the bank. They pay me interest and principal back. Right? That's what these are. So private lending, when you think about lending, right? If you own a home, you have a bank. The bank is the lender, right? They're your lender. You could be the bank is what I'm saying, right? Now let's check this out. Why invest in the first place? And why did I cover this topic? I want to hit this really quick, guys. When we searched, my team did a search on what people are looking at on Google right now, like the top searches in finances. And you would be amazed. Like if I could show you the list, the amount of people and the amount of searches that are on which stock should I buy? Right? Like it's ridiculous. Like this stock, that stock, people are like, literally typing in the name and the ticker symbol, trying to figure out which stock they should buy. Okay. That is not investing. That's speculating. And I've talked about this before, but we have to understand, if we're going to look at this, why invest in the first place? Okay. Why invest? And I'm not going to answer that question. I want you to think about that. Why would you invest? If you're investing, why are you doing it? If you're considering investing, why would you do it? Okay, if you know people that are investing or telling you to invest, why are they doing it? What is their reason? What is their purpose? Okay, like think of that. When I was a financial advisor, I would have told you that the answer was retirement. Here's the problem though. Okay, here's the problem. I'm gonna pull my face back up. Okay, I was, I'm 30 now, right? Retirement age is 65. That's 35 years away. Right? Like imagine being told like you're gonna play, a game like let's say football or basketball, and you're trying to win the game, right? They like score the most points, win the game, do a good job, right? And then someone's like, how long is the game? And then I'm like 35 years. You're gonna play for the next 35 years with no breaks. And it's not gonna be fun because after a year, you're gonna be worn out. You're gonna have 34 more years of the same thing. That's not a reason why I would play the game. That's not motivating to me. That sounds miserable, right? So when I think why invest, someone in the comments said generational wealth. That's part of, again, what's your purpose? Okay, why would you do this in the first place? And I'm gonna go ahead and venture to guess that the average person that invests money or speculates doesn't know why they do it, and that's why they do it the way they do it. Those who lose money don't have a purpose with investing. Okay, I'm gonna say that again. Those who lose money, they lack purpose with investing. They're doing it as a hobby. They're doing it as a speculation. They're doing it because they should. They're doing it because they were marketed to, right? When you have a real purpose, you don't lose, right? Like in my business, I have a real purpose. So we do well with the business. In my marriage, I have a real purpose. So I do well in my marriage. In my physical fitness life, I have a real purpose. So I take that seriously. I go to the gym every day. I diet. I do all this stuff, right? I don't do things that put me at risk in the areas that I have a real purpose. Only when someone doesn't know why they're doing something would they put themselves at risk. Right? Think about it. If you have children, you would never put them at risk. Why? Because they are your purpose. You have purpose behind them. Right? But if I put money at risk, in the last month, if I lost money, I lack purpose with my finances. Doesn't matter how much it was. Guess how much I lost in the last month? Zero. Guess how much I've lost ever? Zero. Why? Because my purpose is that strong. I don't lose it, guys. Right? It's not something where it's like a whoopsie and then it's like, oh, that's too bad. Right? So we have to understand, what is the purpose? Now, the next thing I want to jump into on this, let me resume my show here, is the myths behind stock investing. So a lot of people jump into stocks. It's like one of the first things most people invest in. And it's insane. I bought my first mutual fund with like stocks and bonds and stuff. I think I was like 19 years old. I was like 19 or 20, right? I didn't know what I was buying, like, let alone this is just stocks, mutual funds. There's dozens of them. I didn't know dozens of companies. I didn't understand dozens of balance sheets. I didn't understand dozens of investor letters, dozens of profit and losses, dozens of cash flow statements, right? So what are the myths? Why do people get involved with stocks? We are told, especially for me, that stocks are the best way for the little guy to invest. You can buy there's $100 stock out there. And if you buy the right one and you pick it right, it could double and triple and you could be wealthy off that one stock, right? And so we're told that because the little guy, I didn't grow up wealthy. So for me, like $100 at one point was a lot of money. When I started being a financial professional, the first insurance license test that I took, the test cost me $100. I didn't have it. I had to borrow it from Lexi, right? So there was a time in my life where I was like, man, $100 is a lot. So the idea that I could buy a share of a stock for, $20 or $50 or $100, I thought, me being the little guy, that's how I get in. That's how I get in on the finance game. I can buy these in smaller denominations, right? So that's one of the myths that we're taught. The other myth is investing in stocks, you can make 12% a year. I was a Dave Ramsey guy for a while, okay? I can't tell you how many times I heard 12% growth stock mutual funds. Guys, I can tell you the exact fund he's referencing. It's called Growth Fund of America through American funds. It came out in like 1929. And when you mess with the numbers on it, you can show somebody that if they would have started all the way back in 1929 or whenever that fund started and all the way till today, they would have had an average annual return of 12%. Well, there's a problem is that's not actually how you calculate it, right? And also there's different periods. Like you can't be like, yeah, if you started then and you held till now, that's what you're going to get today. Okay, because that's not the case, right? So we're told you're going to get these high returns when you invest in stocks. Maybe you will, maybe you won't in reality, right? We're also told that when you invest in stock, you own a piece of a business. Most people don't know what that means, right? When I hear that surface level face value, as if I'm not financially literate, I'm like, oh man, I own Apple now. Like I'm an owner in Apple. I matter, right? I can tell people I own Apple. Nobody cares, including Apple, that you own stock in Apple. Their stock was so worthless to them that they sold it. They didn't even want to own Apple. So they issued stock and sold it for money because they would rather have money than owning Apple. See what I mean? Okay. Number 4, stocks are one of the most established ways to invest. We're going to bust that myth in a second. Number 5, stocks are safe. When you hear about it, you're like, okay, well, as long as I have a financial advisor and I pick the aristocrats, the high dividend stocks, it's fine. And then the other one is the wealthy mainly by stock. This one's a load of crock. Okay. And I'm going to share with you why in a second. But guys, these are the myths, right? Now, there are 2 things that you only fall prone to when you're financially illiterate: myths and secrets. Okay. Only the illiterate buy into myths, right? Like if you go to an area where there's like very, very high levels of illiteracy, there's tall tales everywhere. The illiteracy level, it actually breeds myths because people can't explain why things happen. So they come up with stories and folklore and myths. These are stories and folklore and myths about stock that are bought into by the illiterate. Okay, the other one is secrets. Okay, literate people don't have secrets. They don't think things are secrets. That's just the process of learning. I didn't know that, now I did. That wasn't a secret. It's just how learning happens, right? There are no secrets and myths are myths. So what are the truths behind this? The truth. So for point number 1, stocks are actually a way to transfer money from the little guy to the big guy. Okay, what do I mean by that? I like to use the analogy of a swimming pool, right? So if we have a swimming pool and we have the water in the pool and it's at this level, right? And then we start having people get in the pool, right? We got this guy and we got his kids and they're in there urinating in the water, splashing everybody. We got this lady over here, right? And as these people get in, the water starts to rise. Okay, this is called displacement. There isn't actually more water in the pool. There's just less surface area. So the water can't occupy the same space. So it has no choice but to rise up and the level goes up. This is how the stock market works. The more people that get in the market, it drives up prices. Okay, when there are more net buyers than there are sellers, meaning more people are getting in than getting out, prices come up, the water rises. And so we all see that this water marker with a stock, this is called the price, has gone up and we're like, oh, I need to get in right now. Things are hot. Or the price comes down, right? It was here and now it drops down to here. The water drops. Why does the water drop? The water drops because everyone got out of the pool, right? Not only did the water go back to its normal level, but when they got out of the pool, they took a little bit of the water with them because it's stuck to their swimming trunks and their bathing suit and their hair. And so there's a little bit less water than what's in there. right? And the water that is in there, people sweating in it. You don't like, that's the gross thing about swimming in a pool. And I love pools. We have them here, but you don't know with like people's bathing habits, right? That could legitimately be their bath. And you don't know that. Like that's just in the water now. You're just chilling, swimming, you're doing your thing, and you could have all sorts of stuff in there. But when they get out, that's what's left in the water, and the water is much lower. Stocks are the same way. The little guys get in, right? Why do you think it's advertised so much, right? It drives the prices up. The big guys were in already. So they're like, hey, come in the water. It's great. It's fine. And then you get in and then they get out. They get out, they take the money with them. They take the water with them. The market crashes. It goes down. It's not because of some freak political thing. No, people sold. People sold. And because they sold, the price went down. It's basic supply and demand. Right. And then you're left in there in the cesspool with all of the urine and sweat and body odor and nasty stuff. Okay. The other one is the myth that I want to bust here. The truth is, for the average person, they don't buy individual stock. They buy it through mutual funds. Right. The average person is not on, E-Trade or even working with a broker. They're just putting it in their 401k, which puts it into mutual funds, and then they own the mutual funds. Dalbar, they're a financial rating agency. They did a survey, and over the last 20 years, and this is pretty much consistently every time they do it, the average investor makes about 4% a year before inflation and taxes. Net of fees, they're making about 4% per year. That's what the average investor actually takes home on an annual basis. That is not 12%. Right? What about this one? You own a company. You don't. You own a piece of paper. You own a piece of paper that says you own a company. You don't even own the paper as far as holding it. Right? If I own a car, if I tell you I own a car, you would expect that it's at my house. I have it, right? If I told you I have a house, you would expect that I live in the house. If I told you I have children, you would expect that I have children in my possession because I told you I have them. Okay? With stock, you don't. Okay, there's a corporation in New York. I think it's called the DTCC or DTTC, one of those acronyms. And basically this is a trust company. They hold all the stock for everybody, right? So when you buy stock, it goes to them. They hold the paper. You just get something saying that there's paper somewhere that your name is titled to. But it's like saying, I own a car, but I don't actually have it. I can't drive it. I can't touch it. I can't hold it, right? Not only that, but even though you have a share of stock in a company, you don't matter. I'm going to share with you how much you matter in a minute on stock. Okay, you're not being listened to. Like you're sure you can proxy vote, right? But they're not actually like, oh, we should change the direction of Amazon because of what Jerry Fetta's proxy vote said. They don't care. They have a board of directors. They have executives. Okay, they have majority shareholders. Those are the people that they're going to listen to, right? Now, stock investing being established, it's actually younger than lending. It's younger than real estate. It's younger than small business. It's younger than gold, and it's younger than life insurance as we know it today with the current stock market we use now. Right? Like the regulations, there have been semblances of stock markets for a long time. The one we have now was basically solidified in the 1920s, like 1929, 1930 with the SEC. That's when they locked in all the rules. Okay. That's what we trade with today. So could you go look at the Dow and the S&P earlier? Yeah, but it's not the same stock market. Literally none of the rules existed. None of the regulations existed. The SEC didn't exist. FINRA didn't exist. So the system we use today, it's only been around since about the 1930s. Okay. All of these other asset classes were around prior, which means stock investing is actually one of the newer ways to invest. Not only that, but within it, if you take it as a small subsection, you're only as old as the company you're investing in. Right. So if I'm investing in tech startups, that's actually like, sure, it's stock, but it's 5 years old. It's 10 years old, however old that tech company is. So I've got to look at that as well. The other myth is that more money is lost in the stock market than any other asset class. Like it has the reputation such that there are movies made about it. Right. When's the last time you saw a movie other than The Big Short about people losing money in real estate? Or people losing money as a lender, or people losing money in a business? Like that's like few and far between, right? But stock investing, like we all know, you lose money. People lose money regularly. Every 5 to 10 years, they get wiped out. There's literally not another asset class out there that people get hammered as bad as they do as the stock market, and then they still go back. That's the part that blows my mind. They still go back, right? And then the other one is that the number of the top 1%, the wealthy do it. The number one asset owned by the top 1% isn't even real estate. It's not stock, it's small business equity. It's small companies. They buy private equity, venture capitalists, like small companies. That's the number one thing on their balance sheets. Not only that, a lot of them got wealthy through small business. So their top equity holding is the company that got them wealthy in the first place, or it's companies and portfolios that they invest in, right? I was talking to Tax Hive today, our tax company, and they're owned by Kevin OLeary, right? From Shark Tank. Kevin OLeary, he's not telling, he's not out there buying stocks. He's buying a tax company. It's like a small business. They've got, several hundred employees. They're not publicly traded. They're not Fortune 500. They're not even on the Fortune list. It's just a profitable small business that Kevin OLeary owns, right? So why would he be doing that? Because I'm telling you, statistically, that's what the wealthy do, right? So these are a couple of the things I wanted to hit real quick. I want to open this up for some questions just on the truths and the myths of the stock market. Let me pull up my chat here. Oh no, the chat's on a different screen again. Let me figure out my chat. This is not what I'm used to. So really quickly, if you've got questions, drop them in the chat while I try and figure out how the chat works so I can answer your questions. Okay, so first one I see here. Here we go. Good to see you guys. Good to see everyone. Again, really quickly, I forgot to intro Mike and Nano. If you guys are on and you're getting messages from Mike and Nano work for me. Some of you guys know Mike and Nano. They're reaching out one of two reasons. Number one is they want to connect with you to make sure that if you are new, you get a copy of my book, Blueprints of Financial Freedom. Right? We got literally 30 minutes left in this webinar. We're not going to cover everything. All of this and more is in this book. So if you reach out to Mike, if you reach out to Nano in the chat here on Zoom, you can get a copy of this. With the book will come a free coaching call. They can also get you a free 2-week trial to Wealth Dynamics University. Okay, that's our online financial education platform. Literally like over 400 hours of financial education content. So reach out to them. The other reason is they might be reaching out to see if you want to schedule a free coaching call. Let's see here. All right, so let me see what questions we have on Zoom and Facebook. Brad, good to see you. Justin, good to see you. Okay, I don't see any questions on Facebook. I don't see any on Zoom, but again, my Zoom is not working the way that I am used to the chat working. So I might be missing some. I don't see anything so far. So let me go ahead and jump into our next part here on our PowerPoint. So let me share my screen back to you guys again. All right, good. So the thing I want to cover here, and if you guys are clients of mine, you already know this, is investing means to clothe your capital, okay? So to clothe your capital, this is literally the etymology, the root of the word invest. It literally means to clothe your capital. You're putting clothing on your money, right? So I've gone over this before. These are the points that I look for when I pick out clothing for myself. It wouldn't be any different with my money, right? The first thing is I'm not going to wear anything I don't like. Okay, I'm not going to wear anything that I don't understand. I'm not going to wear anything that does not fit me. It must fit my purpose, right? If I'm going swimming, I'm not wearing snow pants, right? If I'm going snowboarding, I'm not wearing shorts. Okay, very simple. I wear what's vital first. I'm going to wear underwear and socks and pants and stuff before I, spend $1,000 on some cool shoes. And then I'm not going to overpay. I wouldn't even pay $1,000 for some cool shoes because I could buy so many other things with $1,000, right? Same thing with investing. I'm not going to invest in things that I don't like. If I wouldn't put clothing on myself that I don't like, why would I put clothing on my money that I don't like? Okay, do I actually like this? And this is the thing is with investing, a lot of people overlook this. They're like, oh, it's just capitalism and you need to find the return. No, I believe like I should be proud of the things I invest in. I should like them. I should have some affinity for them, right? I'm not going to invest in things I don't like. I'm not going to invest in things I don't fully understand. What's the definition of understanding? Can I simply draw it on a napkin and explain it to a 5-year-old? If I can't, I don't understand it. Okay. I'm not going to invest in something that doesn't fit me. I'm not going to invest in something that doesn't fit my purposes. These are two different things. Fit me, my personality. Okay. Like what is my investor profile? How much risk do I like taking on? What are my interests? Like all of these are my personality characteristics. My purpose is, what am I going to use it for? Right? Like if my goal for investing is what I'm going to talk about in a second, passive income, there's a very limited list of things I'm going to invest in because those other things don't produce passive income. Okay. I'm going to invest in what's vital, right? So if I invest in things like food, clothing, water, shelter, transportation, all of these things that people have to use, education, right? Like these are things people have to use. Those are relatively recession proof. So vitality, like how important is it for the survival of humans? That's going to give me a lot more downside protection. And also it's going to give me longer sustainability. And then finally, I'm not going to overpay. This one's hard with stocks. You have to know the difference between price and value. You can't know the difference between price and value unless you're somehow doing an intrinsic value based or an earnings based calculation to find out what's the actual value of that stock versus where it's trading at. That is a mathematical process. That's what Warren Buffett does. Okay, Warren Buffett says he spends at least 4 hours a day studying, right? Looking at balance sheets, looking at companies, like not investing, studying about investing, so that when he sees a company, he can come up with an actual calculation of its value, right? If you're investing in stock, are you doing that? I don't think you are. I don't think the average person is. I think probably a very small percentage of people actually figure out what they think a thing is worth before they buy it in the stock market, right? Now, why do people invest in stocks? Now, this one is maybe not the answer you were expecting. The first reason that people would invest in stock is they're an issuer of it. Right? Like, so if I'm playing the game of get more people in the pool so the water rises, the easiest way for me to do that is to be the one that built the pool. Right? So an issuer, like a company that actually goes public with stock, they win first on the issue because they get to buy it, they get to own it all, they get to issue it all. All that went into it for them was their legal costs. Right? Everything else is just capital raised. And as more people get in the pool, the water rises. It's kind of like being a real estate developer. Right? If I build a property and then I sell it to someone else who sells it to someone else, sells it to someone else, doesn't matter what they sold it for. I made the money first. Right? And usually I made the most money unless we're in a crazy real estate market because I just had the hard costs of building it. Right? I can build the premium. I already know my profit margins. See what I'm saying? So that's an issuer. The other one is a financial institution. Okay. There's two different angles to this. Okay, a financial institution, there's something called pre-IPO. IPO is initial public offering. When a company goes public, then they say, okay, we're going to give the first round of shares out. People can buy in. There's a pre-round. Before they give it to the public, they go to like Bear Stearns and JP Morgan Chase and these giant insurance companies. And they say, hey, guys, before all the peons get in the pool, do you want in? Okay, because you can get in at a discount price. They're going to get in. After they get in, you can sell. Right, is no different than when you're working at like a large Fortune 500 or publicly traded company. If you're an employee, you get to buy discounted stock. Very similar to that concept because it almost works where since you bought it at a discount, you can almost immediately resell it for a profit. You don't have to rely on the market at all. You just have to rely on the fact that more people got in after you. Because of that, your discount price is lower than the sale price on market. You're going to make money automatically. Right? So this is two layers of people who made money before anyone else did. Okay, the next one is the market maker. Okay, a market maker is somebody that buys controlling interest. They buy so much in the market that they can actually sway decisions. They can sway the direction of the market. Okay, Warren Buffett would be a market maker. He's buying, 5, 10, 15% shares in these giant multi-billion-dollar corporations. Okay, and here I am talking about buying, 3 or 4 shares or buying a mutual fund. See what I'm saying? So these guys buy. The other one that invests in stock is a day trader. They don't care what the market does. They're trading on volatility and frequency, right? So they're able to manipulate whether it's up, down, or sideways. They're going to make money because they're just trading. It's just based on trading technique and a lot of times, charting and patterns and trends, right? So they're not in it for the long term. The fifth group of people that invest in stock, they were simply marketed to. They were just told it was a good idea. That's the retail investor, right? The only reason anyone buys stock, unless they're in one of these 4 top groups, is they're a retail investor and they were told to, right? They watched enough commercials. They saw their financial advisor enough times. They were peer pressured into it by their family or their friends or their coworkers. They were marketed to so well that that's the automatic thing they did, even though they don't understand it, even though they know it's one of the most dishonest enterprises in the world, even though there's never been a positive movie about Wall Street and their ethical practices and behaviors. They know all of these things and they still buy it. Why? The same reason people still eat at McDonald's. You know it's fake meat. You know it's not good for you. You know that they've been in trouble over and over and over for food quality, but people still go through the drive-through. You drive by, there's still 15 cars lined up. Why? Because they were marketed to. McDonald's, they're a genius, brilliant marketing firm and a company that does one of the best jobs in the world at that, so that they can convince people to eat unhealthy food that people know is bad for them. No different than the stock market. That's McDonald's for finances, right? If you're buying in this group, you are literally sitting in the drive-thru at the financial McDonald's, right? You're not an issuer. These guys, they're smart. They made the money first. These guys, they got in before everyone else did. These guys, they bought enough where they could actually like have some sway. These guys, it doesn't matter. They're going to make money either way. These guys, they just don't know any better. Right? There's that old phrase, if you're playing cards and you can't find the idiot at the table, it's you. Right? These guys aren't idiots. Right? We know that they're not because their stats say. Right? But when we look at the stats of the average person that's in the stock market, it pales in comparison. The net worth, the income, the savings rate, all of this stuff, like that's the idiot at the table. So if you're the idiot, like just don't go to the table. Go to a table where you're the smart guy. You don't have to go learn about stocks. Just don't go to the table where you're the idiot. You see what I'm saying? And this isn't mean. I'm not being rude. I'm saying like if you don't know something, you had two options. Go learn it. Okay, well, you got to learn more than a day trader and Warren Buffett and Bear Stearns and the companies that issue the stocks and the lawyers that they work with. Okay, what's your chance at learning more than those guys to where you're not the idiot at the table, right? Just go to a different table, like pick a different table. There are several tables you could go to. It doesn't have to be the stock market, okay? Now, the other thing is people don't invest in other things because they don't know about them. We're talking tonight, not just stocks, we're saying stocks versus private lending, right? So people don't know about alternatives like private lending. And so the reason why people don't invest in the alternative assets is number one, they don't know about it. They don't know they could do private lending. Okay. I didn't. I was a financial advisor and I didn't know that that was an option, right? We talked a few weeks ago about life settlement investing. Most people have no idea that that's an option, right? We could talk about, Forex hedge funds. We can talk about seller finance, real estate. We can talk about so many different things that people just don't know it's an option. I can't tell you how many clients I've talked to. We sat down and just even the concept of, oh, you have an old retirement plan. Did you know you could self-direct that so you can invest in something other than Wall Street? No, I didn't know that was an option. They just don't know. Why? Because we weren't told that. There's no incentive. There's no money behind that, right? The second reason people don't invest in alternatives like private lending, they know about it, but they don't understand it. Okay. If I don't know about it, that's one thing, but most people, they know just enough to where they know they don't know. And so it becomes this thing where they're afraid of it, right? Because I'm not familiar with it, because it's new, because it's different, right? I don't understand it. So I don't get involved. Right? Well, this is one of those things where like when you're doing private lending, there's two parties. There's you and the family that lives in the house, right? You've got the money, they don't. So that means you're probably not the idiot at that table. So the barrier to learning is not that high. You just have to be smarter than the people that live there to make sure that they pay you on time, right? There are contracts and foreclosures and all sorts of things you can do, right? So you can know about it. You just have to spend the time to know about it. You have to want to know about it. You want to have other options. If you don't want to know about it, that's totally different, right? That goes back to the fixed idea thing. I believe this, I've never inspected it, and I'm unwilling to. Okay. And then the third reasons people don't invest in it is they aren't marketed to about it, right? How much marketing did it take for America to get covered in credit card debt? Well, the first credit cards came out in like the 1930s or 40s, right? So like we go like, from then till now the average balance for families is like 15,000, right? Between all their cards. And the average person has a credit card. Before that, it was unheard of. So you look at 70 or 80 years of pounding the message home. Not only pounding the message home, bribing you, rewards points, travel points, this, that. And finally, everyone thinks you should have a credit card. I'm not here to say they're good or bad. I'm saying that's how much marketing goes into it. Okay. 1929, the stock market crashes. Okay, let's take ourselves back. Literally the cause of the Great Depression. The reason the depression happened, stock market crashes, right? Why did it crash? Manipulation. Manipulation by all of the above groups. These guys, issuers, they manipulated it. The financial institutions manipulated it. The market makers manipulated it. The traders manipulated it. Who caught the brunt of that blow? The retail investor, like they do every single time in the stock market. You are literally the subsidization for the criminality of these corporations and institutions, meaning they use you. When you buy stock, you are being used by these guys. Okay. And there's no other way about it, because you're the one that always takes the loss. I'm the one who always takes the loss. Right. So 1929, the market crashes. Right. Now get this. They form the Securities Exchange Commission. They do the Securities Exchange Commission. They do the Securities Act of 1933. They come up with all these rules. Who do they put in charge of the Securities Exchange Commission? One of the guys who crashed the market. Right. This is in my book. This is on chapter. What chapter is this? Chapter 11, becoming an accredited investor. Okay. So let me just go through this tiny little passage so I can share with you what I mean here. Okay, good. Here we go. Okay. So Franklin Roosevelt, he was the president at the time. This was around 1929, 1930. He forms the Securities Exchange Commission because the stock market had a giant pump and dump. Like, people pumped up the stock and then they fraudulently sold stock. They made false claims. They got the retail investor to buy it, and then they pulled out, right? They pulled the profit out like they always do. So they formed the SEC. Let's reform the stock market. Let's make it better, and let's make everyone safe. Who do they put in charge? They put in charge a guy named Joseph P. Kennedy. This is President Kennedy's father. Okay. President Kennedy was a crooked Wall Street lobbyist and stock market con artist. Okay. Not only was he a major fundraiser for FDR's presidential campaign, I wonder how he got sworn in as the SEC chair. He's giving enough money to the guy, right? But he made his money by professionally manipulating the stock market in the 1920s to grow a fortune by using what would today be considered the illegal practice of insider trading. He was even one of the chief suspects being investigated in the court hearings leading up to the Securities Exchange Act for his market manipulation. Additionally, it has been stated that Kennedy was trustworthy because he'd invested all of his money in US Treasuries, but in reality, it was a well-known fact that Kennedy invested his winnings, if we can call them that, from his 1920 stock market manipulation into real estate and made a fortune that way. So that happens in 1929. Literally, like, it took decades for people to recover from that. Like our like grandparents and great grandparents experienced that, right? Like, extreme levels of poverty for a straight decade. Imagine that. And now everyone's back in, like it never happened. Okay. This year, the market's getting slaughtered. The number one search topic is, which stock should I buy? Like, at a certain point, you have to stop doing the dumb thing. Right? If the dumb thing is buying stock and then being manipulated by the top 1% in these corporations so that we lose our money, at a certain point, I'm not going to feel bad for you if you keep doing it. Like, if you keep getting abused, don't go back. Don't go do the same thing. If the oven burned your hand, put on a glove next time you touch it. Don't touch the oven again and be like, oh, what's happening? Right? So people don't invest in alternatives because they're not marketed to about it. People do what they're marketed to do. They're told enough times over and over and over that they're like, oh yeah, McDonald's, this sounds like a good idea for dinner. Okay, so here's some more proof. This is what happens if a stock company goes bankrupt. This, for me, like, when I learned this as a financial advisor, I did learn this one on my tests. Right? I did learn this one on my tests. It didn't click. Like, I didn't understand what I was reading because I was just like, oh, these are things that I'm gonna have to regurgitate and get a good grade so I can get licensed. So if I buy stock in a company and the company goes bankrupt, right? Meaning they go out of business. They're insolvent. They're no longer bringing in more than they spend, and they're going out of business. The first group to get paid is unpaid wages. If they have employees they haven't paid, those guys get first. Okay. Second group, unpaid taxes. Okay. IRS gets next. Third group, secured creditors. Now, I want to point out, a private lender is a secured creditor. So when this is a stock company, but when someone goes insolvent, same rules apply. They pay wages, they pay taxes, they pay the secured creditors. Okay. Now, on a home, on real estate, there are no wages. There's a mortgage payment. There's no wages to pay. The taxes, the property taxes, they'll get paid on the escrow, right? So I'm then first in line. See, when they go insolvent, I'm first in line if I'm a secured creditor. After secured creditors is unsecured creditors. After unsecured creditors is junior unsecured creditors. After junior unsecured creditors is preferred stockholders. After preferred stockholders, dead last is common stockholders. If there's even any money left, you get paid last. I thought you were an owner. I thought you had this prestige. I thought you had shares of a business. I thought you were a partner in Apple. No, you're last in line on the lunch line. If there's any slop left, you get some before everyone else gets it before you though. Like this to me was the proof. I don't want to invest in something where in a worst case scenario, I'm the last consideration. Okay. Like on a best case scenario, I just happen to get lucky because I can't predict the stock market. On a worst case scenario, like I'm the last one to get paid. I don't want that. Okay. Now, a couple more slides I want to get through. We'll open up for some more questions. The other thing too is people don't realize the impact of volatility. Volatility is the ups and downs. I don't like those with my investments. I don't like those in any area of my life. I don't like ups and downs. Right? I want steady ups, right? I want, normal conditions with some affluences, some booms in there, and then normals again. So when you lose money, it takes you 2 times as much to get back to zero. Check this out. $100,000 invested. Okay. Now, in 2 different scenarios here. The first year, this person makes a 50% return, right? So this is individual A. This is individual B. Individual B only makes 10%, right? In year 1, guess what? Individual A is bragging. They're posting on social media. They're all of a sudden a financial expert. They're making TikTok videos because they made 50%. Sound familiar, right? This guy makes 10%. Nobody cares. You made 5 times less than the other guy, right? Like you don't know apparently anything about money. You only made 10% when everyone else made 50. Okay, but year 2, what happens? A 50% loss. This 150 is now worth 75. Again, sound familiar? This guy, investor B in year 2, he also still only made 10%. But guess what? Now he's got 120 grand. He's got almost double, right? Not quite, but almost double. Okay. Year 3, though, investor A, he's up 50 again. He's celebrating because he's looking at percentages. I'm going to give you a hint. Poor people look at percentages. Wealthy people look at dollar signs. Okay. The percentages, that's the denominator. The dollar sign, that's the numerator. You care about how many dollars am I getting, not what's the percentage. You don't pay your bills in percentages. You don't become financially free with percentages. You can't buy real estate with percentages. It takes dollars. Percentages almost don't matter. They're representations of dollars, right? So he's celebrating. He's up 50%. He's making his TikTok videos. I just made 50% of my portfolio. Join my free course, even though it's going to cost you $999 after you get into the first one, all this stuff, right? This guy over here, 3rd year up, only 10% again, but he's at 133K. He's still higher. This guy, again, loses 50. Okay. Moral of the story, he's up 50 again. Okay. And then this guy, he's 10 and 10 here. He ends with 84. He ends with 161. Now, if we look at the averages here, up 50, down 50 cancels out. That's a 0. Up 50, down 50 cancels out again. That's a 0. He ends on an up 50. Okay. Now he did 50% up as an average over 5 years. 50 divided by 5 is 10. That's a 10% average, right? But he lost money. Right? He has a 10% average, but he has less money than he started with. Right? The reason why this statement, when you lose money, it takes you twice as much to get back to 0. He made 50% of a smaller number each time. Right? Losing money is more impactful than gaining. When you go into a market where you can lose, your downside is actually more potent than your upside. That's what this is illustrating. This guy, he made 10, 10, 10, 10, 10, 10% compounding annual growth rate. And also he's got 161K instead of 100. Okay. Sure. He didn't have the potential for 50, but he also didn't lose 50. You see, so when I do my private lending deals, I'm making 8s and 10s and 12s every year. Every year I know that's what I'm getting. Okay. It's not going to change. So when the market's up and everyone's making 30% and they're here, I'm not looking at this year. I'm looking at this year. I know in 5 years, I know where I'm going to be at. In 5 years, I know where they're going to be at because everyone has been doing what they've been doing forever. And if it worked, everyone would be wealthy. We wouldn't have poverty. We wouldn't have middle class. We would only have wealthy people in the country. Right? So this is important to realize. You don't want volatility. I don't want volatility. Right? Now, the other thing we've got to look at, we have to look at identities, similarities, and differences. Most people cannot detect these 3 things. So with private lending and stocks, what are some of the identities? Both of them, you can lose money, right? Like nothing is risk-free. So that's an identical part of both of these. You could lose money doing stock. You could lose money doing private lending. Like you could lose money no matter what. Technically, they're both paper assets. Private lending is a mortgage. That's considered paper, right? They literally call it that. Stock, you're buying a paper certificate. So those 2 things are identical. Okay, I can lose money and I'm buying a paper asset, right? Even if I buy a home and I sell or finance the home, when I sell or finance that home, the family that lives there now technically owns the home, right? It's like you and a bank and a mortgage. You're the bank, They're the one living there. It's their home. You own the paper, your first position, right? So even if you own the home because you're the one that bought it in seller finance, on that transaction, you're the paper, right? It's their home. You're the one on the paper. Okay, so those are the identical parts of investing in stocks and real estate, stocks and private lending. Where are they similar? Both of them can produce income, but the income produced is not identical. We're going to talk about that in a little bit. Okay, so they're similar, but they're not identical. There's going to be distinct differences on how the income is produced, how it's classified, and also how much of it's produced. Similarity, both of them require underwriting. Right now, here's where most people go wrong. They think about private lending and they're like, oh man, well, what if the person defaults? I need to know their credit score. I need to know their tax returns. I need to get references. And they automatically know I need to underwrite this person. I need to like dig through their financials and find out what the risk is. Stocks are no different. You need to underwrite stock. You need to look at the company's balance sheet. You need to look at their profit and loss. You need to look at their cash flow statements. You need to look at their investor letters. You need to look at, the forecast of their industry, what they're doing, their technology. Like that's all underwriting. I would rather underwrite an individual family in a single family home than a Fortune 500 corporation that has 1,000 employees. Any day of the week, this is an easier job. I would rather be like, okay, cool. Show me your tax return. Show me your Experian. Good. Okay. Where your rent? Let me see 2 years of rent history. Right. I'd rather look at that and be done with that in an hour than spend hours poring over this and probably never even get the real info. Right. There's this movie called China Hustle. If you guys haven't seen this, they're called shell corporations, also known as reverse mergers. Chinese corporations will buy American corporations that have basically gone bankrupt, but they're still listed on the stock exchange. They'll get relisted. It's a shell company in China. No one can visit China to inspect the goods and see if it's a real company. They just see, the investment banking firm that helped them go public. Goldman Sachs, backs this company. And then all of these big guys will get in on it, pension funds and big investors. And then it turns out nobody ever had any money. Okay, because all of the data that they were looking at in underwriting was fraudulent. And good luck like imposing fines from the SEC on China. And I'm going back to this to share with you, even in a best case scenario, if you're, these are big investors, these are big corporations, you got all the guns, you got everything you need, you still can get taken advantage of. In a stock investing deal, you still could get taken advantage of. You still could be presented with fraudulent information. And then it's okay, great. Well, now I lost money. Hopefully the SEC can enforce. Hopefully FINRA can get involved. Something can happen, right? With this, it requires just, okay, let me see your tax return. The average family owner or seller financing a house from you, they can't fake a tax return. They can't fake a credit report. This isn't like they're professional fraud, like financial fraudulent individuals. Like they're just going to give you their credit report, their tax return, and that's easy for you to look at. Much less chance of you being taken advantage of. Difference, okay? Here are the differences. With private lending, there is no principal fluctuation. I know what my principal amount's going to be. It's a loan. I loaned them this. Here's the amortization schedule. Here's what my principal is. I already know that ahead of time. With stock, there is principal fluctuation. It can go up, it can go down. Private lending, my income, I already know it's going to be in the 8 to 12% range. Stock, it's going to be in the 0 to 4. That's the average dividend rate on a stock. And most of them aren't even that. Like most of them are on the low end now. There's very few stocks that are high yielding. Okay, maybe you can get a dividend in a 6 or an 8, but they're literally like, you Google that, there's maybe a dozen companies you can pick from. So good luck. That's a very limited list. Most of them are in that 0 to 4 range. With private lending, there are no fees or commissions. With stocks, there are fees and commissions. With private lending, there's not a public market, meaning you can't go online and buy and trade private lending deals. That's not a thing. You can go in the private market. You could sell someone your note, right? Technically, you're not even supposed to do that, but you could. With stocks, there is a public market. Because of there being no public market, private lending is very hard to manipulate. Because stocks have a public market, manipulation happens all the time. That's the majority of the growth you see in stocks today, right? Private lending, you do not have to sell your asset to maximize your income. Stocks either require that you sell or you're going to get low yields, right? So you'll hear people saying, oh, you can make 8% or 12% in the stock market. Yeah, if you sell your shares. If you get rid of the asset, when you get rid of the asset, guess what? You don't have it again. Next year, you will not get 8% on those shares because you sold them. Next year, you will not get a 4% dividend on those shares because you sold them. It's not the same thing, right? I'm not selling my private lending deal to get the yield. It just is the yield. I keep my principal, right? Private lending is passive. from the standpoint of my time. I do the lending deal and that's it. I just collect the income. Stocks, if you're doing this right, this is active. Even if you're a mutual fund investor, at a very minimum, you should be rebalancing your portfolio. That's not a passive activity. That's you putting your time into on a quarterly basis. If you're buying individual stock, the underwriting and all the management and buying and selling and watching the market, just the stress of having the app pulled up on my phone. When I used to do stocks and I look at the market every day, I don't want my attention on that. I hate that, right? I want to invest and then I want to go live my life. I don't want to invest and then be stuck on my phone every minute of the day. Like, oh, what did it do? Right? Like that's active. That's not a passive investment. So these are the differences with stock investing. Now here's the bottom line. Okay. These are the hard numbers, the math behind this. If I'm trying to get what's called PI greater than that, this is passive income greater than savings, expenses, and taxes. Okay, that's my goal. I want passive income that exceeds my savings, expenses, and taxes. If you've never watched me for any of these videos before, this is your first time. If you get nothing else from this course, I want you to get that. Your goal financially in life should be passive income that exceeds your savings, expenses, and taxes. Why? Because then you no longer have the obligation of trading time for money. You're financially independent at that point, right? So if I'm trying to get financially independent, check this out. Let's say my number is $20,000 a month, and I'm just making this up. But let's say I'm trying to get $20,000 a month. If I do a private lending deal where I'm making a 12% annual yield, of which I have several, so it's not like, oh, you can't get 12. I get 12. That's not that hard to do. Okay, so in a private lending deal at 12%, I need $2 million. $2 million at 12% pays me 20 grand a month, and I never touch the principal, meaning I will never dig into that 2 million. Right. So all I need to do, $2 million at 12% in a private lending deal, I've got $20,000 a month and it'll keep spitting off. Right. Now, if I'm smart, I'll do the sacred account concept. That $2 million, I'll put that into either gold or life insurance or something I can borrow against. And that $2 million, let's say that I'm putting that into life insurance and I'm making, say a 4% annual return in addition on top of the yield. That's an additional $80,000 a year. That's an additional 6 or 7 grand a month on top of the 20 I'm already making. And the 6 or 7 on the life insurance dividends, that's tax free because I borrow against it. You see that? Now, let's say I do stocks, right? If I do stocks, I'm going to say a good moderate dividend is 2%. That's what you could expect on a dividend on an average stock. We're not talking about if you pick the biggest ones. I'm saying if you just go into picking stocks based on companies you like, maybe you'll get an average 2% dividend because that's just what happens. They're not very high yielding, especially in today's environment. So to get $20,000 a month at a 2% yield, I would need $12 million invested. If I never touch the principal, right? So I never touch the 12 million, right? And I would need 2% dividend. That would pay me my $20,000 a month. But just check this out. Like, why would you want to do 6 times more work? That's 6 times more earning, 6 times more saving, and theoretically 6 times more time. It's going to take you 6 times longer than 2 million, right? I would rather just get to 2 million and call it a day and be done, be financially independent. Now you might be watching this like, oh yeah, but Jerry, they grow, you can get capital gains. Okay, good. So let's say, average between dividends and appreciation, you're doing 8%, capital gains plus dividends. $20,000 at 8%, we do the backwards math on that. That's $3 million. Okay. But the problem is I run out of money in 12 years. If I lock in my 3 million and then I start selling off $20,000 a month, in 12 years, I run out of money. Even if I keep reinvesting, I prolong that, maybe, 15 or 20 years, still I run out of money. On this plan, I never touch the principal. I never run out of money. I never sell the assets. On this plan, I have to sell the assets. It's only a matter of time before I run out of money. See what I'm saying? On this plan here in the middle, like I still never run out of money, but it takes me forever to get there. I don't want to slay the golden goose. I don't want to have to kill the thing that's producing the passive income. That's not how wealth is built. That's how wealth is slowly destroyed over time. Right? Not only that, but like no one's talking about this. When you get a mass population of people that all own the same thing and then they all retire at the same time and they all start selling, what do you think is going to happen? You get, every year, the population, the generations, all of them, they keep getting bigger and bigger and bigger. They keep all investing in the stock market. At what point, when they turn 60, it doesn't matter which generation we're talking about, it's a big enough number that when they all start selling, it crashes the market. right? Like then it's like, okay, I'm running down a staircase and the stairs behind me are breaking and falling down on top of me as I go. I don't want that, right? I want to be insulated and isolated. So when 2020 happened, the crash in March of 2020, I didn't even look at the market. I didn't get affected because I'm not invested in that stuff, right? Last month, in the last 2 weeks, stocks and crypto, they got freaking slaughtered. I didn't. I'm doing private lending. I don't care. None of that matters. It doesn't affect my life one bit, right? So because of that, I get to not only have better financial returns, I get stress-free financial returns. Not only that, but I'm helping families doing private lending. These are families that I'm providing housing for. I feel good about that. They have a nice, clean, safe place to live that they wouldn't have other times. And because of the way I'm doing it, it's often cheaper than they'd pay renting. So they're also saving money, improving their financial condition. I feel good about that. So I'm making money. I've got very low stress and I feel really good about what I'm doing, right? Like I like that. That's a trifecta for me. Okay, so let me wrap this up with our action plan. We're back to doing an action plan. I don't want to just give you info. I want to give you an action plan. So if you're watching this, the first thing you need to do is you need to start skilling up on financial literacy. You need to start studying every day. Okay, learning about money. You can do that a number of places. If you don't like any of my stuff and you never want to hear from me again, go to Investopedia. I don't care. Just learn something. There's no reason for you to learn nothing about money, right? If you want, you can grab my book, Blueprints of Financial Freedom. You can get this from Mike. You can get this from Nano. You can go to jerryfetta.com/B2F. This is a great place to start. You can get a free trial to our Wealth Dynamics University. There's over 400 hours of content. I don't think you'll get through it in 2 weeks, but you'll get through a lot, right? You can go to my YouTube, literally like 1,000+ videos on finances. Go learn something. There's no reason not to learn about money. Okay. So these are all things you can be doing now. It's free. It's very cost effective, right? The other part is determining your number. What is your PI greater than set number? You need to know that. Like, what is my financial, independence number? What is the monthly amount of passive income that I need, right? And the number 3 is recognize where you're at today in reality. The older generations, I don't mean older in a way where I'm saying you're old or antiquated. I'm saying like the more mature individuals, this isn't as big of a problem. They know where they're at. They've got a mortgage and they've got this, they've got that. They have a good understanding where they're at. The people that are my age and younger, literally completely out reality. Like they're like, oh, I'm going to be a billionaire tomorrow. And it's like, what do? I watch TikTok videos. It's like, you're not going to be a billionaire ever. Like this is not going to happen, right? So determine your number. If it was $20,000 a month in passive income, I need to understand, again, $2 million invested at 12%. I need to get there as a target right before I become financially independent. Well, to get $2 million at 12%, I need to be saving and investing over the long haul to get there, or the short haul, depending on how long I want to go. In order to save that kind of money, I need to be earning more than $2 million. I can't save what I didn't earn. So in order to earn more than $2 million, I need to work and produce something. In order to work and produce something, I've got to be valuable and have knowledge, right? None of that's passive. The income is, but all the work leading up to it is not. So if I'm broke or I'm in debt, like I need to have the proper estimation of effort. I can't tell you how many people, they watch so many, motivational videos and they're going to be like, I'm financially independent and it's going to be awesome. And they've got 6 figures in credit card debt. And somehow they think in 2 years, they're going to be financially independent by doing flips and real estate. Right. And it's like, no, that's just not how it works. Like that's not how it's worked for anyone. You got sold a dream and it's not real. Okay. You're going to pay off your debt. You're going to increase your income. You're going to save. You're going to invest, and you're going to make smart decisions and not lose money until you get to that number, right? It's no different than losing weight. If I'm 100 pounds overweight, I'm not going to have a 6-pack in 3 weeks. It's going to take me maybe years, because it took me years to get 100 pounds overweight, right? And you want gradual because that's sustainable. So once you've recognized where you're at today, take your next step. Don't take the one 10 steps down the road. Don't take the one that Elon Musk took. Don't take your next step. If I'm just at the point where I've just now got savings, my next step isn't buying real estate. My next step is saving more, starting to use stores of value, maybe doing some tax planning and different things. Like, what is your next step? You need to take that. That's your next step. Don't listen to other people and their next step. And then persist. This isn't going to be done tomorrow. This might take 5, 10, 15, 20 years. But here's the thing: is it's your freedom. How long are you willing to give yourself for freedom? Right? Are you going to be like, oh, freedom took too long, so I'm just going to stop and be in slavery forever? No, I'm already in slavery. I'm already not free. So any amount of freedom is better than none. I don't care how long it takes to get there, because at some point I will. Persist and keep going. And then lastly is don't lose money. Okay, when you lose money, you go backwards. Like you've got to get, all the way just back up to where you were. That took longer. And if you lose it again, now it takes even longer. And if you lose it again, now it takes even longer. And if you keep putting yourself in positions where you lose, eventually you got to look at, maybe I just need to play a different game. Right? Like I was talking to one of my guys. He's like, yeah, we have this person. She wants to move over her retirement account, but she just lost money in the market. She just lost money in the last month or so. And she wants to wait till it comes back. If you lost already, why would you stay in the thing that just lost? If you're trying to regain, why not regain in something that's not going to lose again? Get rid of your downside and go into something that's only got upside. Right. And again, nothing is guaranteed, but if I just lost, I'm not going to go to the place that just stole all my money and say, give it back. I'm going to say, okay, I'm done with this. I'm going to go somewhere else. Right. So guys, I'm going to open this up for some questions again. I know that we have some on Zoom. Let me pop these up really quick. I think we have some on Facebook as well. All right, let's see what we have for questions. Natasha asks, how do I receive the book? So Natasha, connect with Michael in the chat, Michael Kerrigan. He can help you get the book. And again, that does come with a free coaching call. That also comes with a 2-week free trial of the Wealth Dynamics University.
You got a question from Keith on Zoom.
Okay, cool. I'll get to questions here. We have a question here from Michael. Let me bring Michael on live. All right, so we've got Michael here. Let me see if we can bring Michael on. All right, I don't think Michael has a microphone, so I'll just read Michael's question here. Michael asks, where do we find notes to buy? So I don't buy notes, like I don't go to people that have notes already and buy it from them. There's 2 different ways that I invest for private lending. The first one is going to be with a fund. Right. And you can ask my team about this. It's very difficult to find a good fund because as soon as you say, hey, I have money to lend, everyone's gonna be like, oh, well, Michael, I have a real estate deal. It's perfect. Right. So you want to make sure it's someone that's actually qualified. They have a registered fund with the SEC. They're doing all the right things. They've got a track record. So we have funds we work with. My team is happy to help you with that. The other way is seller financing. You actually buy the home and then you seller finance it to an end user or a family. And that's the other way that I like to do it as well. But I don't usually just buy notes from people. And again, usually when you buy notes, your secondary market, like there's a lot of stuff I don't know at that point. And there can be more risk with buying notes directly. Doesn't mean you can't do it. I know people that do it, that trade notes around and buy notes. Mark says, look at who runs the treasury now. I haven't even been paying attention to that. Let me bring Mark on so I can get the scoop on who's running treasury. I think it's Yellen now. Hey, Mark, am I right? Is it Yellen?
Yeah, it is Yellen, and her last statement she made was that she corrected herself when she historically said that inflation was transitory, and then she actually said she admitted that she was wrong, and inflation is probably going to be here for a while. So, yeah, it's just like letting the fox guard the hen house, right?
Yeah. And if you look at before that, so it's Yellen, and then I think it was in 08, 09-ish, they made Hank Paulson Secretary of Treasury. He was the Lehman guy. Like he was the wolf that like he said, the wolf or putting the fox in the hen house. Like he literally was the one that caused the 08 crisis, and then they put him in charge of the treasury. Not only that, he got like several $100 million in avoided capital gains tax, because when you go into public office, you're forced to sell and you don't have to pay taxes. He was able to exit at the top, pull the cream off the top, pay no taxes on it, and then be the U.S. Secretary of Treasury. Keith asked, why did Amazon stocks just split? I'm not sure why Amazon stocks just split. That was a long time ago when I did those courses on stock split. So if you asked me 10 years ago, I could tell you all about them. I haven't involved myself in stocks in almost over a decade now. So I have no idea why Amazon split or what Amazon's doing. But again, it's one of those things where to me, just that, like the confusion, complexity, having to ask why that happens, that to me is an indicator with an investment, right? So I don't have to ask, why did my private lending deal split? That's not a thing. I just get the income, right? So those are things when an investment has odd indicators, or it does things that don't make sense, or I've got, you know, a lot of complexity or significance that I've got to look into. Usually, like, it's, you know, I've got to like it, I've got to understand it. Usually that's if I don't understand it, or I've got to put a lot of time into understanding it, it's not the investment for me. So I know with stocks, you know, you know, there are technical factors, and then there are also just, oh, because the company decided to, right? And some of those are just arbitrary as well. Good question, Keith, on that. We can maybe see if we can find an answer on the stock splits, or if anyone knows, drop that in the chat too. Nano says it will go back up. That's the cliche with the markets. Mustafa says, I need the books. So reach out to Michael Kerrigan. If you go to Michael Kerrigan in the chat, you can reach out to Mike and get the book Blueprint to Financial Freedom. And then you can also get How to Create Wealth. This was the very first book I ever wrote. This is literally like how many pages is this? This was super short, 57 pages. This is one that I wrote like super short. Here's the basics of what you need if you want more information. This is the more information version of that, but reach out to Mike. Mark asks, can you please elaborate on the return? Please elaborate on the ROI, return of investment and return on investment. Okay, so basically, I think what Mark is asking is kind of like yield versus annual growth rate, right? So like if I have an investment that's paying me, you know, 12% yield, the return of that investment is going to be 12% of that number, right? That's going to be, okay, this year I know that I'm going to get, you know, 12% of 100,000, $12,000, right? So that's a return of the investment. That's the yield. Now, return on investment is if I take, let's say it's $12,000 over the next, you know, 10 years, I can take that, that's 120 grand plus my original 100, and I can put in the buy value was 100, right? The sell value was 220, my original principal plus the 120 in gains. And that's going to give me a compounding annual growth rate. Okay. The compounding annual growth rate, that's the number you would predict future growth based off of over a long period of time, typically is going to be lower than the yield, right? It doesn't mean I'm not making 12%, but when I factor in reinvestment and compounding, that compounding annual growth rate is often going to be a smaller number than, you know, the annual return or the annual yield of the investment. And this is where people get confused because they hear I'm making 12% this year on a stock, and they think that's the annual return. So they start using their savings and investing calculators, predicting with those numbers, when really they've got to look at how many dollars did I put in and how many dollars do I have now, and what's the compounding annual growth rate of that, you know, buy value, sell value, and that's the real number. And I think that's what Mark is getting at. If it's not, please clarify, Mark, but I think that's what Mark was asking about. Good. That's all the questions I see on Zoom here. Let me see what we have on Facebook. Thank you guys for joining, by the way. Again, if this was helpful, if you learned something, be sure that you share this. Okay, Vanessa has a great question. She says, what is the difference between secured, unsecured, and junior unsecured creditors? So secured would mean that, like, on a home, for example, if I lend on a home and that home is serving as the collateral, I'm secured by the home. That's a secured creditor. So if the borrower defaults, I can take away the home. Or like on a car loan, right? That's a secured loan. Unsecured is like a credit card, right? A line of credit. It's backed by nothing, right? Now that unsecured, if a default happens, I can put a ding on your credit score and I can, you know, try and sue you and do all these things. But at the end of the day, if you don't have the money, you don't have the money, and I don't have any sort of recourse, right? And then junior unsecured usually means it's another position behind, right? Like person one loaned the money, and then person two loaned the money to person one. And so they're going to be different positions. This could happen on unsecured as well. So you could have junior secured, or, you know, first position, second position, third position. And so these are different positions where, you know, like on a real estate deal, it can still work out. Okay, if there's enough equity, the first position can get paid off and the second position could get paid off on a home being, you know, defaulted on or foreclosed. But if it's unsecured, it's like, okay, well, the first person might not get anything. The junior guy certainly isn't going to get anything, right? And so that's kind of like I wouldn't ever do junior unsecured lending. I wouldn't ever do unsecured lending, period. But Justin says, I'm enjoying my private lending deals. That's awesome. I'm looking forward to helping you do many more. Vanessa says, the corruption with big old googly eyes. It's pretty deep. There's a lot of stuff you can learn about. And again, like with the corruption, guys, like it's not new, right? Like we can look and rant and rave and talk about how bad the markets are. And the reason why I go over that is because you shouldn't be in them, right? Like it literally, it's the equivalent of eating McDonald's, and you just shouldn't eat it. Like if you want to, great. I'm not your parent. I'm not your guardian. You do whatever you want to do, but it's not good for you, right? But if we can get also like tied into the conspiracy theories of who's doing it and why and what the bigger plan is, none of that matters. Like if you just like, it doesn't matter how McDonald's makes their meat because I don't eat their meat. Right? It's kind of like the stock split question. You know, that's a valid question, but it's like, okay, well, I don't invest in stocks. I don't care. I don't know about that. I'm not interested in that. It's not something I spend my time learning about. Now, back when I did stocks, sure, I learned about that, right? But it's one of those things where it's like, I haven't done that in 10 years, right? So I can look at, okay, well, you know, there's so much corruption. Who's behind it? I don't really care. Like that's not something that impacts my wealth at all. So I'm not going to spend time and energy on it. I just know that it is there and I know what I'm going to do about it. What I'm going to do about it is first, I'm not going to get involved. And then second, I'm going to tell you guys about it so that you don't get involved, right? So that's kind of the idea behind why I share that. I don't want to share doom and gloom. It's kind of like the inflation thing. We know inflation. It's been around forever. Like it's not a new thing. It's not going to kill us this year, right? Like it's going to slowly erode our purchasing power, sure. But you know, it's like one of those things where we've always already known about inflation. If you're surprised by it, like I don't know how you haven't figured out or known before. It doesn't matter why it's there or who's causing it. What are you going to do about it? Right. And how is your financial world going to be impacted by your decision in relation to the fact that inflation exists or in relation to the fact that market manipulation exists? So guys, I'm going to wrap up here. If you have any questions, reach out to my team. You can contact Mike Nano. If you send an email to michael@wealthdynamics.com, michael@wealthdynamics.com, if you want to connect with him, whether you're watching the replay or not. Again, if you want to get a copy of my book, go to jerryfetta.com/B2F. And if you would like help with finances, reach out to my team. Guys, we have a growing team of people. It's not just me. So when you work with us, you get service from our sales team, our delivery team, our client relationship team. Like it's a whole experience. And so, you know, if you would like help, reach out. It's like a free call. It doesn't cost you anything. If we're a good fit, awesome. If we're not, you know, there's no harm, no foul. But we would love to help out or just answer questions. So feel free to connect with us. Otherwise, have a great weekend. I will be back again next Friday, same time with another great course, and I'll see you guys then.